Hello guys, welcome back to Zodiac Trader. So today we'll be looking at this article. Inflation is proving sticky as Fed Chair Powell heads to the Hill. As I have mentioned previously, I have mentioned that inflation is probably going to come back, and if not only that, inflation is going to be even more sticky. So now it all happened again. As we can see right now, we're having this reflation, which is driven by multiple factors. So there are several reasons why we are having this inflation embedded with our macroeconomic system. First, it's because we have Trump going back to the office. We have the tariff, which is likely to be placed to even more magnitude. And right now, Trump is already launched his tariff against Canada and China. And now still, the U.S. is still waiting for uh, Mexico's, I would say, further follow up to see if the Mexico is willing to cooperate with U.S. regarding to the border issue. But as a matter of border issue, will be a little bit more complicated because, as a matter of fact, Mexico is currently overthrown and controlled by drug cartels, which is not definitely not a good thing, right? When your country is ruled or being controlled by mafia, you're not going to have justice. The society is going to be pretty bad, definitely out of shape. So Mexico, right now, could be a uncertainty factor. The second reason why we're having this inflation back is that we have wage growth, we also have rent growth, and then we have an imbalance within the job market, partly because of the LA wildfire, one of the biggest and largest wildfire in, I would say, in the whole LA history. So, not surprisingly, the the wildfire will actually destroy temporarily of the local job market, the employment market of California, and also the LA. I would say mostly for LA. So that imbalance is going to stick for a while. We're going to see more of employment imbalances, and we're going to see, because people's house got burned down, we have more fires, and that's why people have no home to stay. People would have to wait for the government to take further actions, and that's why we're going to see skyrocketing rent, and that rent could be another contributing factor to also to the inflation. Third reason why inflation is coming back is that currently, uh, not only we're seeing stronger uh, kind of wage growth, we're seeing more imbalances of the job market. We are also witnessing PCE, all these crucial inflation indicator going up, which could cause further risk of having inflation going back up towards 3%. Right now, the inflation is climbed up a little bit. So I would say it's not a good sign. That's why the Fed decided to have a policy of higher for longer, and that higher for longer policy is going to stick there for a while. Okay, so in this article we see what like Jerome Powell is going to say regarding to the inflation issue. So UK GDP also due. ECB Lagarde would testify to lawmakers. Philippines set out to cut rates with Russia likely to hold. As I have mentioned previously, I said about Russian central bank is probably doomed because the its ability lacking of ability to control of the hyperinflation currently taking place in Russia. We're seeing hyperinflation taking place in Russia, which is out of control. So Russian central bank is going to stick for a while and probably do take some extreme measure to bring down that inflation. But right now, because of the war, because of the Ukraine war, we're not probably not going to see uh, the Russian inflation is going to get any, to get any better. So the situation could be worse off for Russian economy. Okay, so U.S. inflation showed scant signs of downward momentum at the start of the year, which while healthy job growth undergirded the economy, backing the Federal Reserve's stance to hold the line on interest rate for now. Fed Chair Jerome Powell, who offers his semiannual testimony to lawmakers on Tuesday and Wednesday, will likely highlight the resilient economy as a key reason central bankers are in no rush to further cut borrowing costs. With the economy in a good place, federal officials also have the time to assess the impacts of the new Trump administration policy changes on trade, immigration, and taxes. So yesterday, Trump and the new head of Treasury, Ben Stent, has brought up a new idea of bringing that inflation back down. That they are talking about bringing that 10-year yield down. So they're basically trying to, what they're probably going to try to do is probably going to, keep buying bonds to make that yield to go down. So I would say that's a good method, but probably not going to work for some reason because of the conundrum. Next time I will find, I'll definitely make a video about this conundrum thing. Because conundrum used to describe in a certain scenario that if a central banker intends to bring that, to manipulate that the bond yield either going up or going down, but the market, by raising rates or probably lowering rate, and the central banker is probably not going to success, probably not going to get what it wants in that kind of dilemma. So it happened. This kind of conundrum happened during Alan Greenspan's period of Fed. So it happened in 2007. So it used to happen. So right now, President Trump and also Ben Sanders, they are probably going to face the same challenge. Okay, so Bureau of Labor Statistics figures due on Wednesday, shortly before the second half of Powell's 2 days testimony marathon, are forecast to show the consumer price index excluding food and energy rose 0.3% in January for the fifth time in the last 6 months. So we're actually seeing, this is what I've been saying, we're seeing, labor market going stronger. We're seeing inflation coming back, especially the PCE. Especially we see that the consumer price, excluding food and energy, rose 0.3%, which is higher than estimated. So that means the Federal Reserve endeavor to bring down that inflation is probably right now stagnating. So compared with a year earlier, core CPI is forecast to have risen 3.1%, while marginally lower than the annual figure for December. That's just a 0.2 percentage point decline from the middle of the year. Okay, so sometimes they look at PC, sometimes they look at the core CPI. You never know, right? That's a very strange and weird thing. Sometimes if Jerome Powell might tell you that he prefers to see that PCE. Sometimes he say he has to check that core CPI. But nonetheless, you never know. So the Fed, by saying this, they prove themselves to be crazy data driven, which is tons of bullocks. So U.S. inflation has proven stubborn. So January consumer price index seemed rising 0.3% for a fifth time in 6 months. So after a sizable decline in 2023 and early 2024, progress towards further disinflation has essentially stalled. Just as the job market revved up late last year, on Friday, Labor Department data showed payrolls growth in the last 3 months through January averaged 237,000, strongest for any similar period since early 2023. So look, this is the thing that you're seeing these strong labor market, right? And sometimes you ask a question, why do people lose job despite of these strong labor data market? That you have to look at the structure of the labor market data. Sometimes you have increasing supply of lower paying job, those kind of fast food job. You have more of these jobs, but you have less of the good paying jobs. That's the issue. And then it turns out you have, really strong job data, but as a matter of fact, in reality, people around you probably got sacked or just lose their job. Okay? So that's why when you are looking at the data, you see a very strong labor market. But people around you lost your job because you have more of the contractor sort of job. You have more of these part-time jobs instead of these good paying jobs. Those jobs, you know, those jobs actually could be called as jobs with career. That's the case. So that helps explain why Fed officials are content to stand pat for the time being after full percentage point rate cuts in 2024. Moreover, proposed policies from the Trump administration risk keeping inflation elevated. What Bloomberg Economics says, Chair Powell has said the Fed needs to see real progress on inflation to some labor market weakness to consider adjusting rates. We think generally CPI will offer mixed evidence. We expect headline and core CPI inflation both rose 0.3%. So CPI report, which also includes an annual update of seasonal adjustment factor and a reweighting of components that go into the index, will be followed on Friday by retail sales for January. Economists estimate another healthy advance in merchant receipts for the month, excluding motor vehicle dealers. Meanwhile, President Donald Trump announcement that he intends to unveil reciprocal tariff this week will be watched for their potential impact on both U.S. and world economy. Okay, so looking north, the Bank of Canada's summary of deliberation will offer insight into the central bank's move to strip off forward guidance from its rate decision due to the uncertainty of Trump's threat of tariffs. Elsewhere, UK growth data, testimony by European Central Bank President, Indian consumer prices and rate decisions from Russia to Peru will be all among the highlights. So Asia data published on Sunday showed that China consumer inflation accelerated for the first time since August, caused by a burst of household spending around the Lunar New Year holiday, even as the inflationary pressures persist. Still in China, you see a very large force of deflationary power, which is not good. So Chinese economy is, its decision it has to think about instead of having its debt restructured, it should really think about how to have a solid and serious monetary stimulus instead. Otherwise, China is not going to get the inflation it wants. That would be the case. For the remainder of the week, India will be the main focus after the world's fifth largest economy unexpectedly reported the weakest growth since the pandemic. Its central bank on Friday delivered the first rate cut in almost 5 years. On Wednesday, industrial production figures are likely show India's slowing in December and consumer prices started 2025 easing to the slowest pace since August. Wholesale prices, though, another measure of inflation, likely accelerated. We will also get January trade data on Friday. So moving east, consumer confidence data is expected early in the week from Indonesia. Vietnam provide figures on vehicle sales, and Malaysia releases the final reading of gross domestic product for the fourth quarter. The Philippine Central Bank is forecast to cut its lending rate. Not really important, so I'm just going to skip No offense, but not really important, not really my focus. But I would just jump right into the Japan. Japanese producer price likely accelerated on annual basis and held firm in January from the prior month on Wednesday. The country also releases preliminary machine tool orders for January, a snapshot of global demand of its once world's largest manufacturers of the machines. This measure jumped the most since June in the prior month. So it's very worth mentioning that Japan, BOJ, right now it's in the process of raising its interest rate. So I'm guessing that in 2025, if the dollar remain weak, somewhere between DXY between 106 and 108, Bank of Japan probably going to persist its raising of interest rate. And you're going to see that Japanese yen, bottom and then going strengthen further. Now we already witnessed the like JPY versus dollar. We already have see that dollar yen reached to 151 or so. So I am guessing I don't think that yen is going to go past 150 for now, but definitely every time when dollar is going to weaker, that would be another opportunity window open up for the Bank of Japan. Okay, Australia releases several measures of how nations feeling. Generally, business confidence and February consumer sentiment. New Zealand published credit card retail spending, new 2 year inflation expectations, blah blah blah. So Europe is I would say its economy is right now stagnated. So you're going to see more, pessimistic sort of economic growth. We're going to see bad GDP growth. It's not looking good. So forecasters split on how gross domestic product fared in the fourth quarter, with some reckoning on a small contraction of 0.1%, while others see either stagnations or even modicum of growth. BOE speeches will also draw attentions, with Catherine Mann, one of the two officials who sought a half-point rate reduction, scheduled for Tuesday. Appearance for Governor Andrew Bawley and policymaker Megan Green also on the calendar. So this chart is rather very interesting, worth to look at. The BOE warns of slower growth, faster inflation. So it's a rather interesting combination of both. That you're seeing slower GDP growth, but in the same time you're seeing inflation slowly bottom, but then climbing bit up, and that's going to bring stagnation. That's a pretty bad economy situation. That means you don't have GDP growth, and then you have inflation going up, and even though you're trying to lower the rate, you already finished the process of raising rate, that you think you have handled that inflation problem, but that inflation is coming right back. That is a tricky thing. So in the Eurozone, industrial production on Thursday is a highlight, along with final inflation numbers from Germany, then Spain the following day. The second reading of region GDP is due on Friday. So taking the lead among European Central Bank speaker will be President Christine Lagarde, who will testify to lawmakers on Monday. And elsewhere in region, consumer price data will be major focus, with Switzerland first inflation reading 2025 due on Thursday will set the tone for the next move of Swiss National Bank, which lowered borrowing costs by a half point in December. January saw cost cut for electricity that will weigh on inflation. And the median forecast of economists is for an outcome for just 0.4%, which will be the lowest since 2021. Norway, Egypt, Israel don't really care. Number of central bank decisions scheduled, and Zambia don't really care. Serbia, Bank of Russia, already mentioned. Look at its inflation is holding at 21%, which is hell. Like it's giving people hell. How could you tolerate that 21%? That's why Russia bank go back to the gold standard. So Latin America don't really care. People really have attention. You could pay a little bit of attention to read this article. But for now, I already covered major economists and their thoughts. I already covered what's happening in the central bank around the world recently. So higher for longer is going to stick for longer, definitely longer, and for a longer while. So as investors, I highly recommend that you should keep your hedges. Don't forget to hedge your positions. Do not don't forget to hedge the risk, and you have to embrace the volatility because and also uncertainty because for Trump as a macro trader and investors, when you're facing Trump, the only thing that you can do is basically by projecting or analyzing Trump. You never know what's going to happen next because he could say one thing and he could easily flip that over and then he very quickly change his view. So that's going to create more difficulty when we trying to understand economy nowadays. So thank you for watching this video. And if you like the content, please subscribe, like, and I'll see you in the next episode. Goodbye.